A portfolio generally refers to a collection of something. An artist's portfolio, for example, could hold a sample of drawings and paintings, whereas a writer's portfolio could include poetry or short stories. As an investor, your portfolio is a collection of the investments or securities you hold. Your portfolio's performance is mainly based on the price growth or decline of your investments, as well as any income you might earn from dividends and interest. There are different types of interest. Many of us know that interest is what you pay to a lender over and above the money you borrow from them. Lenders set the interest rate that you pay, and it's usually represented as an annual percentage of the amount that's borrowed. Compounding interest can have a major effect on the growth of your portfolio. Compounding growth occurs when an amount of money that has been earned by interest grows even more thanks to the interest it then earns on itself. Simply put, it is interest on top of interest, and this could snowball into a large sum of money over time. Let's look at an example. For the next 3 years, Susan decides to keep $500 in a savings account that earns her 10% in interest each year. This means that every year, she earns $50 in interest. Susan will take out and spend the $50 interest every time she gets paid and always leave the initial $500 saved. By the end of the 3 years, she will earn a total of $150 in interest, and her funds would have grown from $500 to $650. However, if she were to keep the $50 interest payments in the savings account, then they would grow in interest along with her original $500 contribution. Let's run through an equation to calculate what Susan earns with this option. At the end of 3 years, Susan's funds would have grown to $665.50, earning her a total of $165.50 in interest. By reinvesting the interest earned each year, Susan would earn $15.50 more than she would if she were to withdraw the yearly interest payments instead. Over a long period of time, this compounding effect can have a huge impact on the growth of a portfolio. Let's change the time frame now to demonstrate. How much would Susan have if she kept her $500 and the yearly interest payments in her savings account for 10 years, not 3? In the formula, we'll change the value of t from 3 to 10. Because she is saving for a longer period of time, this further compounds the total amount of Susan's funds to more than $1,200. This earns her a much larger interest payout of almost $800 over 10 years. You don't have to use this equation if you are not mathematically inclined, but we went through it to show you the power of compounding interest. If you'd rather avoid remembering this formula, you can also use an online compound interest calculator. Ultimately, the relationship between time and rate of return shows just how important it is to start saving or investing early or for longer periods of time. Compounding interest is one factor that can impact investment growth. How you construct your portfolio can be another. Portfolios should be tailored to an individual investor's needs. You can construct yours depending on your risk tolerance, timeline, and investment goal. While portfolios can be highly customizable, here are some common types to consider. Conservative. This type of portfolio is constructed with the goal of bringing in income to the investor. A sample portfolio may consist of a 70-30 split between bonds and stocks. Conservative to moderate. This type of portfolio is constructed so that the investor can try to receive not only income, but growth as well. A sample portfolio could be a 55-45 split of bonds to stocks. Moderate. If an investor's primary goal is to try and grow their investments at a moderate pace over time, they might construct a balanced growth portfolio. For this portfolio type, it could be built with a 40-60 split of bonds to stocks. Aggressive. If an investor has a high tolerance for risk, then they might try to grow their funds significantly over time with investments that are usually considered more risky. Because of this, the investor is at risk of seeing significant loss in their investments as well. These investors generally weigh a lot more heavily in stocks versus bonds. A sample portfolio could be 20% bonds and 80% stocks, but some aggressive investors may also focus entirely on equities. Before you construct your portfolio, it's important that you first create an investment plan. Think about your investment goals. What are you building towards? Retirement, a large purchase, or a new home, for example. Now that you know the basics on portfolios, let's take a closer look at the types of securities you can include within them.